Hello, and thanks for joining us for our webinar on the 2017 Crop Outlook. I'm Jim Minter, Director of the Purdue Center for Commercial Agriculture, and joining me today are my colleagues, Dr. Chris Hurt, Professor of Agricultural Economics at Purdue, and Michael Langemeyer, who is also a Professor of Ag Economics and Associate Director of the Center for Commercial Agriculture. So today we want to spend a little bit of time talking about the implications of a couple of pretty important reports that came out from USDA just last Friday. And of course, USDA released a grain stocks report as well as a planting intentions report for the 2017 crop year. So let's talk a little bit about what we're going to cover today. We're going to have a little summary of the information contained on the USDA reports themselves, talk about some crop budgets and the implications of the economics for crop producers here in Indiana and around the Midwest. So Chris, let's take a look at that stock situation. And there were some changes on this report that were a little bit of a surprise.
Well, that's right. And we look at the numbers here of how the stocks came out relative to the expectations. So corn, we'll look over to the right-hand side. We saw the actual stocks numbers about 65 million bushels higher than anticipated. Now, if you look at that 65 million in relationship to a 2.3 billion bushel expected carryout for the old crop, that's only about 3%. So relatively small, and we just call that fairly neutral. Also at the very bottom of the visual, you'll see the wheat, 32 million bushels higher than expectations. And again, that represents about 3% of pushing up to over 1 billion bushels of carryout. So where we really see some impact is on the soybeans, 56 million bushels more stocks than what the anticipation was. That's 13% of the carryout. So that is a significant number. It is a number that says we have more soybeans on March 1 than what was anticipated. Now on soybeans, we have pretty good measurements on the bushels that are exported and the bushels that are crushed. Those are the two big categories. So what to end up with more beans with pretty good knowledge on the usage probably means that last year's crop may be underestimated. Last year's crop could actually be larger. And I think the implication of this is that when we see the April WASDE report supply-demand update, we'll probably see USDA increase the old crop carryout maybe 25 to 30 million bushels. I think that is bearish on top of a bearish report for soybeans in terms of the acreage numbers. So I think we got kind of two strikes against soybeans out of the reports most recently.
And Chris, you think about that increase on the carryout, the 56 million bushels. If you think about that in terms of yield, if you put that all back on yield, that's almost but not quite a full bushel per acre. It's a pretty big bump.
That's right. We had tremendous record yields in the United States, extraordinary, almost unbelievably, around 5 bushels above trend last year. So could it even be better? And the answer to that seems at this point with this stocks report to say, yes, those yields may have even been better than that.
Yeah, that's the surprising part because we already had the high yield expectation built in.
That's correct.
And now we're bumping it up even more.
And again, remember that these are surveys. So plus or minus a couple percent on those surveys would be quite normal. And USDA may not buy into the idea that for sure last year's crop is bigger until we really see the third quarter and then the final, at the end of the summer, final stocks report. But it is an indication halfway through the marketing year that we have more beans than we thought.
Let's take a look at the acreage, Chris, because that was really the big news, I suppose, on Friday, or at least coming into the report, that was what people were focused on most heavily.
Well, that's right, and I think the stocks can really be a surprising report, and we saw some of that on soybeans as we talked about. But we see a lot of drama in these trend lines for corn, soybeans, and wheat. Corn up at the top and reduction of acreage pretty sharply. We took 4 million acres out of the corn this year, and again, that is the prospective plantings that we just saw. Then, of course, especially the about last 4 years since the 13 crop on soybeans to see the dramatic increase in soybeans. Go back 4 years, 13 crop, about 74 million 74 million acres up to almost 90 million acres on soybeans. This is a lot of drama for a mature industry like agriculture, where normally we'll only see 1 to 2% change a year on some of these numbers. And of course, our competitive position in the world on wheat is not very strong. The wheat is represented by the bottom line, green line on our charts, and we see continued drama. And these are, again, very major reductions in the last 3 years, going from about 57 million acres to 46 million. You know, talking nearly or over a 10 million acre drop on wheat. You know, what's going on here? Well, one of the things going on is that soybeans have been high priced this last year relative to corn. So we see that shifting. And wheat in general, prices, we have major surplus problems in the U.S. on wheat, and that's reflected in low prices for corn, low prices for wheat, shifting into soybeans. Some pretty big numbers here.
And as you point out, really the industry responding to the changing economic environment. We saw that with corn earlier. As corn became a lot more profitable, we boosted corn acreage pretty dramatically. Now we've been in a period for at least several years now where soybeans have been more profitable than corn for many producers. It's taken a while to get that shift to take place, but boy, we saw it take place in spades on Friday.
I think that's right. And again, this is Adam Smith's invisible hand to the market. You know, well, what's causing these shifts? It goes right back to prices. Prices are sending signals to producers that we need more beans. There's a reason for that too. The growth of Chinese purchases of beans continues to be relatively strong, and that annual increase as a percentage increase is greater than the relatively minor growth we're seeing in corn at this point. So I think if we had to talk about the next 5 years or so, we would continue to say we'll probably see that bean number go up overall and corn acreage maybe more flat, or maybe down a little bit. Now this also is going to be tied up with the world situation, and certainly South America can expand bean production and absorb more of that Chinese expansion. So we'll have some dynamics, but the trends I think will continue to be towards more soybeans. Now we see here soybeans almost at the same acreage of corn. We've never seen soybean acreage planted be higher than corn acreage planted, and this is the corn acreage planted for grain production.
Could happen this year depending on how things play out during the planting season.
That's correct.
And if it doesn't happen this year, I think based on our outlook, it could easily happen here in the next couple of years.
Well, and we are seeing several states like Indiana that are planting more beans this year than corn.
Let's take a look at some more details here with respect to the report on Friday, Chris. Planted acres, looking at it on a crop-by-crop basis.
Yeah, we'll look over to the right-hand side, look at the changes, the 17 intended planting versus the 16 actuals. And the red rectangles represent decreases. The big ones, of course, corn acreage down 4 million acres and wheat acreage down about 4 million acres. And we'll go down to that fifth largest crop, sorghum. It's down about 1 million. So what we saw, feed grains related to corn and other feed grains like sorghum, down. Then if we go down to about midway on that visual to oats, barley, also down, and some of those percentages pretty large in terms of acreage. So really shifting out of feed grains and shifting towards oil seeds is what we saw. Then basically, why is that? We talked about that. That's what the world says we're shorter on. Where did the acres go? Let's just take 3 of those crops, corn, wheat, and sorghum, 9 million acres roughly, less acres. Look at the soybeans. 6 million went to soybeans, 2 million went to cotton in the south and the southern plains. So those are big shifts out of corn, out of wheat, out of sorghum, and over to corn and soybeans and into cotton. If you hit that button one more time,
there we go.
There we go. We'll focus on just a little bit regionally. Eastern Corn Belt, reduction in the red in corn and wheat, and that all went into soybeans. Sounds very logical. In the Western Corn Belt, it was a shift from corn to beans. pretty simple shift. They don't have a lot of wheat there. Then we look at the plains, some really big acreage out on the plains. That was both corn acres, but a lot of wheat acres. Where'd it go? Went into soybeans. So again, we see this pretty much regionally, that the either corn or corn and wheat headed into soybeans this year.
So any concerns there, Chris, with respect to yields as we look at the shift in corn acreage from corn to soybeans? I'm looking especially at the western corn belt, central plains, northern plains, picking up a lot of acres for soybeans.
Well, that's right. And again, there will be implications because these are fairly large numbers of acres. And that does put a little more negative pressure on soybean yields with that big acreage headed into soybean yields, especially in the northern plains, especially, or even into the southern plains.
So it kind of has some implications as we go through the growing season.
I think that's right.
To pay attention to weather in maybe a little more strongly in some of those regions than we did previously.
Absolutely.
Let's look at some prices.
Yeah, so here we're going back to 2012. That's the record high price in terms of, these are U.S. average prices or marketing year average prices. We call them with the commodity programs. Looking at corn, $7 corn then reaches the bottom in this period from 12 to 19 for the 16 crop. So last year's crop that we're marketing now, $3.40. That's what USDA has for a U.S. average price. Our numbers for the 17 crop, then $3.75 corn, and then going on to the 18-19 crop, I'm using the futures and then trying to adjust that as best I can to a U.S. average price or marketing year price. And what we see there is the low price, the lowest of the prices in the current crop we're marketing now, with some pretty considerable improvement for the 17 crop, and then some improvement going on to 19. And there's the $4 magic level, but that's not until the 2019 crop. Now we know futures can change on a daily or an hourly or minute by minute basis, but I think this is sort of the best outlook we can give you right now. Soybeans, we go from $14+ soybeans to the 15 crop of around $9. Then we had some weather problems in South America about a year ago at this time. Beans went back above 10. USDA has them averaging $9.60 for the 16 crop. Then with this big acreage number, we're going to drop beans. I've got them on down in the lower nines, $9.35. And then futures markets continue to erode bean prices on down longer term. Let's just call it $9, low $9 level. So I think there's some perspective here. Are we suddenly going to bounce back to price levels that'll cover all cost of production? The current outlook tends to say no, that we still have quite a bit of adjustment to work through with some pretty modest prices, but improvements in corn and wheat, but no improvements in beans, probably some weakness in bean prices
and
longer term.
Chris, you mentioned adjustment. We're going to talk more about this later, but our expectation is we are going to see some adjustment. It's going to take place on the cost side as we try to rationalize our cost of production to accommodate these longer term price forecast, right?
Well, that's right. And again, prices are determined by a global set of supply and demand conditions and other economic events. This is, I think, the best outlook we can come up with now. There are some other outlooks that do long-term forecast we could talk about, but we have to, as producers, accept the reality of the marketplace and then try to make adjustments to accommodate that. Now, that's not to say that would be pleasant. Another event that could come along, what else could change? A major change in world supply-demand conditions. So supply-demand has two components to it: supply, weather. Generally, we've had very good weather and above-trend yields worldwide, generally over the last 3 years. Something that would change that, some weather problems in a major growing area. The demand side has dynamics to it as well. Could there be some kind of growth, major change in the exchange rate of the dollar, which continues to look very strong, so that's not in the current outlook, but could there be some supply or demand factor that would change that? Those aren't foreseen at this point, but they certainly could come along.
Good point. Let's take a look at the balance sheet, Chris.
Yeah, so looking at the balance sheet on corn first, we'll go over to the right-hand column. These would be the projections that we've made here at Purdue. Taking the planted acreage at 90 million acres, harvested at around 83 million. We're using a trend yield at about 170 bushels per acre. And in the chart then, that gives us a crop of 14.1 billion bushels of corn. First thing to note is last year's yield, the 16 crop yield, not 14.1, but 15.1. This is a billion less bushels of corn. That is a noticeable number. And so as we carry this through to the ending stocks towards the bottom, we get ending stocks down in the range of 350 million bushels. Now that's a number that begins to change the overall situation, I think, for corn. We've got a U.S. farm price at $3.75, a 35-cent increase, and of course some pretty good range on that. But I think that is a significant change. One of the things we would have to say, though, is the extraordinary 16 crop, lots of acreage and very good record yields. That gives us extraordinarily low prices. We'll see the $3.40 U.S. average price compared to the previous 2 years, more $3.60, $3.70. So we might say that what this is doing is getting us back more kind of the level of prices we'd been before the tremendous record crop of 16 really depressed corn prices.
Yeah, so Chris, just for clarity there, ending stocks on the 16 crop coming out of the 16 marketing year, 23-20, looking ahead a year, you think that could drop almost 500 million bushels. You got down to about 450, right?
I guess that's right. I misread those numbers. So under 2 billion, I think the market says that's a meaningful drop.
Yeah, that's significant going forward, and that's a bit of a surprise coming into this report, right? I mean, that was a little...
That's correct. Yeah, I think that's correct. And again, to get that down in the low twos would have been the discussion. But and again, we'll have to see what the acreage is, and obviously yields will be important. But we start with 1 billion less bushels of corn production versus last year. That begins to make some changes, getting us back in a level of usage that's closer to the usage level we've had.
And it gives us some optimism about these corn prices, at least going forward here a little bit.
It changes the tone in the market to some more optimism.
Some of the viewers are probably looking at your range on corn, and we talked about this before the webinar, Chris. What would it take to get to that 425?
Well, we were thinking 5 to 7 bushel drop in yields from that 170.
Which would be a big drop below trend.
That is, but is that out of the picture for the last 10 years? And the answer to that, of course, is no. I'd say maybe in the 15% odds, you'd look at a weather possibility that could drop 5 to 7 bushels on yield. So weather is obviously going to be very important. And if we have weather scenarios that do give us prices above $4, that means some people probably are going to have some shorter yields if it is U.S. weather that gives us those kind of prices. But it's in the possibility set where probably before these reports we would have said may not be in the possibility or very low odds.
Conversely, on the lower end, it would be looking at yields that are significantly above trend, higher production numbers, and perhaps some softer demand showing up.
I think that's right. And again, on the demand side, if we have a reasonable crop, I think our feed usage will still go up. We're going to have at least probably around 2% more livestock and meat and animal products. Our ethanol, we've got it up a little bit. Again, I think that's primarily related to the energy markets and how much gasoline we use. I've got exports down pretty sharply. Again, with a record South American production on corn, I think we will drop our exports. So again, it feels to me like our usage side is pretty solid in that 14.5 billion bushels. And so if we drop much below that 170 bushels, I think we do have more upside potential on price.
Okay. Let's take a look at those ending stocks to use ratios across the three major commodities, corn, soybeans, and wheat. And there's some changes on those charts, right?
There are, especially wheat. These are really big numbers, and we've seen it for multiple years, big decreases in wheat production. And so our problem on wheat, the line up at the top, is that we started with this 16 crop with 50% of a full year's usage never used, unused when we're ready to harvest the next crop. Those are 30-year highs on inventories of wheat in the United States. Now, that's a substantial drop for this 17 crop down to around 40%. But to say the U.S. is running out of wheat, no, that's not the case. We still have abundant stocks of wheat, but it is a major change in the right direction. The middle line is the corn, and what we see there is the first real reduction for the 17 crop on the basis of our projections after 4 years of increasing inventories. So yes, we had some very tight inventories in the 2012 drought year. Those were record high prices, but then 4 years building inventories. So I think that's a positive sign as well, to be getting our inventories of corn back in a little bit better balance. The cost of that, lower wheat acreage, lower corn acreage, is some movement up in our inventories of soybeans. And so the consequence is lower bean prices as we get strength in corn and wheat. But some progress. Just looking at the old crop corn, I think we probably would say with this report, this big downside we've had for the last 3 to 4 weeks, from near the $4 level on old crop corn down to around below $3.65. That probably is over for now. We build the case that perhaps you could retest the high end of this range on into this spring, early summer without a weather problem. And we see that gets us on old crop futures back up in, say, the 385, 390, 395 range. So I think those are kind of the pricing opportunities we'd look at this point. A return of maybe 20, 25 cents a bushel higher than where we had been. Again, this will get ethanol plant prices back up around $4 a bushel probably. And at other buying locations, at least the higher threes, 375, 380 kind of cash corn prices. So a chance to sell again at some of the highs that we'd seen this year.
Okay, let's take a look at new crop.
So new crop, same pattern, of course. And I think there we're looking at the $4 up at the highs that we had seen on corn. And so I think for most people, seeing that we even touched after the report $3.90 D's corn, looking at that $4 price level as at least a level to start doing some pricing on the new crop, at least the initial pricing on the new crop. So all of this is good after 3-4 weeks of pretty much downside and a lot of discouragement, a little recovery in these corn prices. And then we're really going to talk about the weather. Can we do better than these prices? A weather scare in there would tell us that yes, we will do better than that. You would see both of those futures prices on a weather scare go higher than these levels.
Michael, let's take a look at the break-even prices. You've updated your budgets
Yes.
that you do on behalf of Purdue, and take a look at the
Let's start on the far
changes.
right. It's more optimistic compared to the far left, obviously. If you look at high productivity ground, we're getting closer to the prices that Chris was talking about. If you adjust for basis, some of the prices that Chris was talking about, you're looking at 360, 370 corn. Our break even is getting very close to 4. And so if we have some continued reduction in cash rent, we're going to be closer to the break even on high productivity ground, at least in Indiana. The average productivity is still quite a ways from break even, so there's more pressure on the average productivity ground to reduce cost, and there's even more pressure on the low productivity. And quite frankly, that's a little bit of a scary scenario on the low productivity. You're talking at more than $1 difference between the total cost per bushel and the expected price, and so there's a lot of cost reduction needed for the low productivity ground. What's one of the sources of that? Cash rent.
So, Michael, for some clarity there, let's put some yield numbers with these productivity categories. On the high side, what are you
We're
looking
looking at 205 bushel on the high side, 170 on the average, and more like 135, 140 on the low productivity. And so in Indiana, the average and the high would be more common. But we do have some low productivity ground, particularly in the southeast.
And so your budgets would suggest, as they have for some
Yeah.
time, that the most pressure is going to be on the low productivity
Definitely.
soils. significant amount of pressure on the average productivity.
Yes.
And on the high productivity, some pressure perhaps, but
not near as much as on the low and the average.
and I think we need to recognize also that the budgets that we're projecting that you've put together are kind of an average cost situation. Some farms have costs that are below what we're suggesting, right?
Yes, that's very important to point out. And also, we're assuming a cash price. And so, again, it goes back to what Chris was talking about. If you see some pricing opportunities in that 390 to 4 range, even with average cost of production, you're very close to break even.
On total cost of production.
Yeah, on total cost of production.
Now I want to go at the average, and we talk national price, $375, but here in Indiana for the 17 crop, maybe $385, $390. You've got an average total cost of $445, so that's 50, 60 cents. So you're probably $80, $90 an acre short. How do they make that up?
Well, there's two big sources we've been talking about this winter. One of the sources is cash rent. I don't think all of it can come from cash rent, but there's still a need to reduce that cash rent, particularly on the low and the average productivity ground. The other source, I think, is to look at two relatively large costs to see what you could do with respect to seed costs. Look at the seeding rate. Look at the price you're paying for the seed corn. Is there something you can make some kind of adjustments there? And also fertilizer. Is there some ways that you can look at your fertilizer program and make some adjustments that reduce that fertilizer cost per acre?
And those probably aren't going to close the total
They're
gap.
not going to close the gap, but anything we can do to try to come closer, closer to the cash price is certainly positive. But this is no different than what we've been seeing the last 2-3 years. Unfortunately, looking at corn margins on average productivity ground, we've been looking at $100 losses this time of year for the last 3 years. Right. Now, obviously, we didn't have $100 losses on the average productivity soil last year because yields were pretty good. But these are using trend yields, and so with trend yields, you're still looking at some pretty big losses in 2017 on average productivity soil.
And it remains to be seen what kind of an adjustment actually is taking place with respect to cash rent. In your budgets, you have built in
a 5%.
A 5% decline relative to what we saw in the Purdue Land Values Survey from last summer. It remains to be seen what that number turns out to be when we get the updated survey information later this summer in 17. So let's kind of summarize here a little bit, Chris.
Well, I've probably made most of these points. That old crop inventory, remember, we're going to carry over about 2.3 billion bushels. What does that mean? That's a crop, last year's crop that we're still not sold yet. We're going to store it on into September, October, into the new crop. That probably means that basis is really going to struggle mid to late summer. Too many farmers hold on to inventory of corn, waiting for a weather possibility to get a rally. That does or doesn't happen. There's a huge amount of corn in that mid to late summer that has to come to town, and that really can collapse the basis. Remember, who's going to carry the corn from old crop to new crop? That's going to be the commercial industry, and the commercial industry only does that if they have an incentive. So as we get out there to July and August, we expect old crop to be discounted, or to say it another way, new crop to be at premium to the old crop to give the incentive for the commercial industry to store. So we've already talked about retesting on the old crop, 385 to 395 on the July or summer futures. We have already said the new crop acreage is going to be down, and that's shifted over to beans. I think, Michael, you're still saying overall, even with the price reaction that we've had out of these reports, beans down and corn up still favors on our Purdue budgets to plant soybeans, so not a big rush.
And we'll get into more detail here in a little bit related to those two.
Then for the new crop, $4 corn, we've talked about that. That's futures, I think is still very much of a possibility. And the overall direction, as I see on corn, is up. Now, it's not up as much as we would like to see, but I think that is the general direction. We make a fairly good increase for the 17 crop. Futures markets are talking about adding a bit more to that for the 18 and 19 crops.
And Chris, as I look at the 8 points you've got listed there, probably that's the one that I would probably focus on the most, is that maybe we have seen the bottom from a longer term perspective in corn prices, barring something really unforeseen, especially on the yield side perhaps, that the corn price direction is actually starting to drift up a little bit?
And I think the reason for that is that markets have gotten the corrections of or shifting of acreage that we need to see. And I think the other thing about up is that says there's hope. We want it to be up more than that, but at least there's hope. Are we through the worst in terms of the low prices? And I would tend to say that is the case on corn and wheat. We're through the worst of it.
Okay. Let's turn our attention to the soybean side, and we've kind of alluded to this, but I think this is going to be the negative side.
Yeah, and that's if you add something on corn, you take it away on the beans, I guess is the way it looks. First, let's look at the 16-17 crop. We've got USDA's using a carryout of 435 million bushels with a 960 U.S. average price. And we have to talk about that 56 million bushels of stocks higher. What does that mean? What is going to change? As we said, that probably will go in at some point to some higher carryout. And I would guess 25 to 30 million bushels that USDA might increase that 16-17 carryout. Now that's primarily, they can't put it on the crush, they can't put it on exports, I don't think, so probably it's going to go into the residual category. And that will be to reflect that we could have a higher production from last year's crop. Now I didn't change it, I left it at 435, carry that over into our estimates for 17-18, and with the 89.5 million planted, I'm using 47.7 bushels per acre. That gives us a crop of 4.2 billion bushels. And interestingly, with so much more acreage going to soybeans, yields last year were so high, you bring them back to normal, you have a smaller crop, even with 7% more acreage. So that's the encouragement at this point, I think, is that just had enormous yields last year on soybeans. Again, go to the bottom line. I've got this carry out up to 460. If USDA adds 25 to 30 for the 16 crop, that would push you up towards the 500 mark. That's a scary number. That's below $9 beans. So at this point, until USDA makes a decision what they're going to do with the stocks, I've got it $9.35, dropping about 25 cents a bushel on the soybeans.
With some risk, it could be a little lower than that.
Oh yes, there could be a wide range around that number. The long-term futures support on soybeans is around $8.50. So I think that's our downside risk. And remember, that's futures, so that says harvest time prices on beans in the lower $8 with a very big production this year. And again, remember, we're assuming the acreage does come in as what USDA has surveyed here. So I think you just got to talk about the downside on soybeans. This is the summer futures, July futures. And again, we can see a lot of us kicking ourselves if we still have old crop beans going back to 1080 4 or 5 weeks ago. Now looking at beans pushing to the lower nines, and I've got them maybe some support we'd see around 940. But still, with the basis pretty weak on beans, that gets us down to 920 or 925 cash bean prices going into this summer. Can we get a recovery? I think it's largely a weather situation. Will we get a weather rally? And that weather rally maybe gets us back to cash beans at 950. So I think those people that sold beans above $10 cash, we heard a lot of talk from analysts of saying if you can get over $10 cash, those are good prices on beans. You should be doing some of that. Again, we'd like to go back and redouble our effort to get people to sell above 10. But I think a lot of people did. All indications are that we had aggressive selling of beans above the $10 mark. So I think that's been very good. Great yields last year, selling above $10. As Michael mentioned, that came close to paying the bills last year. Flipped a new crop, and that even looks weaker. Where do you find support on the November futures? That's down in the lower $9. So I think if the perception in the marketplace is that we're going to plant those acres to beans and we have normal yields, you still got downside on the new crop to that futures down in the low 9s, and of course that takes us cash bids at harvest in the high 8s, and then being able to sell November futures back in the higher 9s would obviously be what we would hope to be able to see. But I think our outlook is that overall you still head lower on these bean prices and get us down in the very low 9s or high 8s at harvest time.
Yeah, so what you're really suggesting, Chris, is we could come back and challenge the lows we put in last summer. We got soybean prices last summer for the November futures just above $9.
That's correct.
And there's pretty significant risk we could test that here probably relatively soon, right?
Well, I think that's right. And, we may get a bit of a bounce. We had a big downside. We may get a bit of a bounce. And basically the bounces or rallies, we're looking to do some selling on those rallies. These are not very enticing numbers when you're below possibly $9.50 on new crop futures. So I think a lot of people will be hesitant. They'll tend to wait for that weather rally or the surprising purchase from China, or maybe a weather event in some other part of the world.
You did some interesting work here to kind of look at the long-term ratio or relationship between corn and soybean prices, and this is pretty interesting, Chris. Let's take a look at this.
Okay, and again, what we're looking at here is the price of soybeans divided by the price of corn. And this is a chart that actually goes back 10 years and looks at that relationship. The long-term average is around 2.5 as a long-term average. Now again, if you're reading market commentary, a lot of people use the futures market. This is the actual cash market, and that is averaged around 2.47 to 2.5, we'll call it. Now if we go back over on the right-hand side, go back a year ago, we see that ratio getting up to 3 and a little bit over that, 3.1. That was the loss of over 100 million bushels of production in South America back in the spring of 2016. That loss of world production caused bean prices, as we know, to go back above $10 and give us the opportunity to sell soybeans above $10. Now, what we see is a correction of that. We see that that gives incentives. Bean prices are high relative to corn, gives incentives for more soybeans in South America as well as the Northern Hemisphere. We've now seen that reaction in terms of the U.S. plantings, and we're dropping back more towards the average soybeans, about 2.5 times relative to corn. Now, over the last year, beans have been high priced relative to corn. What we'd say now is with all these acreage shifts, we're actually going to see that relationship become more normal, assuming normal yields. So what are the implications of that? We have on the next slide. Let's look at the ratios up there. We said 3-to-1 ratio over on the right-hand side. Beans are high priced relative to corn. The average is more like 2.5. Let's look at the $3.50 corn, kind of a cash price that we've been seeing. With a 3-to-1 ratio, that gives us $10.50 beans. That's kind of where we've been. $3.50 corn, $10.50 beans. A 2.5 to 1 ratio gives us 860 beans with 350 corn. Now we're talking corn higher than that on a U.S. basis, 375. So with the ratio being more normal, 2.5, that gives us bean prices more like the low 9s. So that's pretty consistent with our outlook right now. 375 corn, some of you are saying, well, beans should be 3 times that. That's what we've been. That'd be $11 beans. Not probably in the picture. So resetting these soybean prices relative to corn.
And then, again, it's an attempt to bring things back into equilibrium.
Back into
right?
equilibrium. And so when Michael runs through his budgets with $9 beans and $3.75 corn, he's going to say, well, that's closer to a balance where some producers are indifferent between corn and soybeans. And that's exactly what markets do. They drive these relationships back into more normal relationships. But as you saw on that chart of the bean price to corn price, boy, that can change a lot. If the U.S. has a great corn crop and a poor bean crop, or South America has a major weather problem, that's what really shifts those relationships. on price.
Michael, let's take a look at the break-even prices for soybeans. Again, off the Purdue budgets that you've put together.
Yeah, one of the things I wanted to start out with is 2016 was an extremely good soybean year, and so a lot of producers made money on soybeans because the yield was quite a bit higher. And so I did want to throw a little bit of cold water on that, because if we go back to trend yield, we're actually looking at negative margins on soybeans, just like we have for corn. The margins aren't as big for soybeans, even with the adjustment in prices that Chris and you have been talking about, but nevertheless, the expected margins are negative. It's a very similar relationship as we saw as corn earlier. The margins are very close to break even on the high productivity ground. A little bit further away on the average productivity ground, so there's some need for reducing costs on the average productivity ground, and there's tremendous need to reduce costs on the low productivity ground. So it's a similar story to corn, but I did want to point out that that our expected margins for soybeans are negative. They're not as negative as corn, but they are negative for 2017. So there's also that need to try to reduce costs for soybeans.
So again, for clarity, Michael, as you look at the productivity categories, what yield numbers do you have behind those budgets?
I have 42 bushel soybeans on the low productivity, 52 bushel on the average, and 62 bushel on the high.
Okay, so we can use that to kind of calibrate
Yes.
a little bit.
And I'd come back and, as we did on corn, say, okay, if we're down in the lower nines on actual cost, looking at the average
Yeah.
category, you're not quite $2 of
Yes.
loss.
Yeah.
So you're, again, $80, $90
Yes.
an acre in terms of
Very
not covering
similar
total
corn.
cost. Very similar.
Yeah, very similar to corn.
Coming into more
Yes.
equilibrium, equal losses in
Yes.
this case, corn and soybeans on your
And that
budgets.
hasn't been the case for the last 3-4 years. Last 3-4 years,
Right.
when the dust was settled, soybeans were considerably more profitable for corn. And quite frankly, I was a little bit surprised that we didn't have more of adjustment of soybean acres last year. There was actually more difference in profitability sitting in April of 2016 than there was when this new report came out at the end of last week. But having said that, we didn't have the adjustment to this year, and so this year's a little different than what we saw the last 3-4 years. We're seeing a much smaller difference between the corn and soybean margins after these new acreage estimates have come out.
Yeah, so that's changed a lot just since January, for
Yes.
example, right?
We were looking all winter. I was updating the budgets, and it was looking like soybeans were more profitable than corn on average productivity soil, anywhere from $60 to $100. Now that's much tighter. It's more like $20, $30.
And again, market prices do their job.
Yes, they
Remember,
do.
it was late in 16 and early 17 when those soybean prices were 3 to 3.1 times corn prices. Markets were saying the market needs more beans, not more corn. It did its job.
Yes, it did.
So, Chris, let's kind of summarize the soybeans.
You know, we hadn't mentioned that South America had record production. That's just been realized here in early March and moving into March. So that was really the depressing factor for the last 3 or 4 weeks. We talked about the stocks numbers, higher than expected. That could be another negative for the soybeans in addition to the acreage. And again, we think USDA could well add 25 to 30 million bushels to that old crop carryout if they become convinced that the 2016 crop needs to be raised. We saw the shift on the acreage, heavy shift into the soybeans this year. The new crop carryouts will probably grow and give us lower prices. So old crop beans, what's the hope there? Well, any rally that we see probably should be sold. And again, sell old crop beans above $10, that seems to be a dream at this point, unless there's a weather concern that comes up. And we did talk about several times, these bean prices are resetting now relative to corn. And cash prices, $10, probably not in the picture anymore. 9.5 would seem like a really very hopeful goal at this point on old crop beans or new crop.
So, as you think about it, Michael, current prices favor the rotation of soybeans over continuous corn, and you've looked at that in a little more detail in a way that you can kind of equilibrate those.
What we've done here is we've tried to incorporate the soybean costs and the corn costs for the low, average, and high productivity ground, and then we've asked the question, what would corn price need to be, the minimum corn price we would need for each soybean price on the left. I've got $9 soybean price highlighted here because Chris has been talking about the strong possibility of having cash prices as low as $9. And so with continuous corn, it still favors rotation soybeans. This is looking at for low, average, and high productivity. And so that story has been very consistent the last 4 years. And so I'd like to spend more time on the next chart, which shows continuous soybeans and rotation corn. Now with the acreage report, we do have more soybean acres than corn acres in Indiana and several other states also. And so you are going to be seeing more continuous soybeans than we've seen in the recent past. And so let's take a look at this very carefully. And again, I've looked at soybean costs for continuous soybeans and also incorporated rotation corn costs and asked the question, if we had a $9 soybean price, what price would we need for corn minimum in order to switch to corn? And this has really changed since last Friday. We were looking at this winter, if you looked at we were looking at 950 soybeans, for example, we would need a corn price above $4, $4 to $4.10. Now, if we're looking at $9 soybeans, and we're looking at a corn price that would need to be on high productivity, 372 or above. That seems like that's possible.
Absolutely.
And so on high productivity in particular, it looks like we're equilibrating here and really getting close to similar margins. There might be still some advantage on average and low productivity for continuous soybeans, but I would like to point out here, I have not reduced yields for continuous soybeans. Some of the research would suggest that we would need to lower soybean yields at least somewhat if we were looking at continuous soybeans. And so I'm assuming that this is second year beans, not third or fourth. If you get into 3, 4, and 5 years of soybeans in a row, certainly these corn prices would not need to be near this high in order to favor rotation corn. But this is much different than what we saw before the report on Friday. And so I wanted to spend some time talking about that, as we really are getting closer to the same margins for soybeans and corn, with this new acreage, and that's a big change from what we've seen in the last 3 or 4 years.
Yeah, so if you were thinking about a continuous soybean program, or at least a multi-year, maybe not truly continuous, but a multi-year soybean program, the revised budget suggests you should think twice about it.
Yes, that corn-soybean rotation is still very, very beneficial and very attractive in many cases after you look at something like this. Let's talk briefly about contribution margins. I think we've already discussed this quite a bit. We have corn and soybean contribution margins, and the contribution margins are basically a return to variable costs, and the costs that are not included that need to be subtracted from the contribution margins are the overhead costs. In this case, they include cash rent, operator labor and hired labor, and machinery ownership costs. Repairs and fuel have been subtracted out already, and so they're not an overhead cost, but the machinery ownership costs are. And all we're showing here is that there is an advantage to soybeans slightly on each of the low, average, and high productivity, but the difference is much smaller than what it has been in the last 3 or 4 years. And so we're seeing those contribution margins gravitate towards the same levels. But unfortunately, we're still not covering the overhead costs, and so we're not there yet. If you start looking at $4 corn, as Chris was talking about, maybe a year or two out, certainly on the higher productivity, we're going to be much closer to that break-even point.
And again, as we've pointed out previously, when we look at the low productivity budgets here in Indiana and elsewhere in the Corn Belt, the gap between the contribution margin and the overhead cost is even wider than it is on the high productivity or the average.
And we haven't talked about it because we don't grow a lot of wheat in southern Indiana, but what other crops can you grow on some of this low productivity ground? Wheat's not very attractive, and so there isn't a lot of options, and so there's just a tremendous need to try to reduce costs, particularly cash rent on the low productivity ground.
Chris, you've done a little bit of looking at the weather situation, because at this time of year people start thinking about, one, planting conditions, and then secondly about growing conditions. So you want to walk us through that?
Well, I would say I've looked a little bit. National Weather Service, they've done a lot of work. So at least we'll look at their numbers here. And on the left-hand side is temperatures, and basically what you have on temperatures throughout the spring and growing season is above normal temperatures. On the right-hand side of these visuals is the precipitation, and the first, this is looking at the spring season, April, May, June, and of course we notice the upper Great Plains and Minnesota in that and parts of Iowa above normal precipitation. So, you know, this could be some delays in planting. We're already wet in the northern Great Plains, and so above normal precipitation could mean some planting delays, and that these might be opportunities to get that rally, to get to some of those levels we had talked about. As we go on into the summertime then, we're just looking at their June, July, August, so this is kind of centered on July, and the temperatures on the left-hand side continue to stay above normal. Above normal temperatures, everything else being equal, tend to probably lower yields below trend somewhat. Then on the right-hand side, we see the continuation of moisture in the northern Great Plains, but not Minnesota. And then we see kind of a bullseye in southern Indiana, Kentucky, for an area that could be on the drier side. Now, it's unusual to have these little dots, little bullseye, to be that precise of where that might be, but I think it is at least a warning that we could have, as we often do, some regional areas of the Midwest or country that do have some dry conditions. So fairly normal start to the planting year. At this point, is there any dramatic call for problems? No, but I think we do see some possibilities that could develop.
And we'd anticipate that the market would be paying pretty close attention to these, right?
I think so, and especially on corn, where
Yeah.
we're starting to bring our inventory down.
And NOAA updates these once a month. These were from a couple of weeks or so ago. They'll be updating those again here in the middle of April.
Right.
People are going to be looking at those. So
Absolutely.
as you're walking at the market
Weather
news,
is minute by minute watched during the growing season.
yeah, it'll be paid close attention to.
Then this is the forecast of the Drought Monitor. And what we have, particularly that we think of influences corn soybeans, would be that Missouri, Western Illinois, Eastern Kansas area. And what the National Weather Service is saying with this forecast through the end of June is that that drought is likely to be removed or improve. So that would be the threat, I think, to corn and soybean production. And that is out there now, that dry conditions in that area. National Weather Service is saying our best guess is that's going to go away. So that doesn't suggest any major threat to corn and soybeans. Threat remains to the wheat crop on into western Kansas, eastern Colorado, and certainly the western side of Oklahoma.
And Michael, you were pointing out, as you look at the map, there's drought persisting in parts of the southeast, and the implications that's having, and particularly for some beef cattle producers in that part of the world.
Definitely, that area has been pretty dry here the last few months, and it looks like that's going to persist. And so this is not the webinar where we talk about livestock prices, but nevertheless, that's going to create some challenges for some livestock producers in that part of the world.
Forage availability, a problem
Yes,
in
definitely.
particular, right? So.
Well, and that could be on the plains as well. Obviously, those dry conditions, big cattle country out there.
So one thing that's important to think about as we think about returns is to think about what the government program payments might be. And Michael, you've done some estimates for the 2016 payments that would be paid here in the fall of 2017.
And we've also estimated the 2017 and 2018 payments, or lack thereof, is probably a better way to put that. But there's a couple things that we're trying to illustrate with this particular graph. One of those is for most of the state. It may not seem like it because we only have a few counties represented here, but for most of the state, the payments for corn are going to be substantially less than what they were last year. That's particularly true in northern Indiana. It's less true in southwest Indiana. If you look at southwest Indiana, their corn payments are going to be as strong as what they were last year. But northern Indiana, we're looking at much smaller payments. And these are fairly recent estimates of what these payments are expected to be. As we go into 2017 and 2018, we're really essentially looking at no payments for corn. I'm not showing you the soybean chart. The soybean chart is rather boring, but it's also a little depressing. It's very hard to find a county in Indiana where we have a soybean payment for 2016, 2017, or 2018. And so the main reason we want to show this is, as we've looked at some negative margins for corn and soybeans, for at least for the northern half of the state, we're really not going to get much help from the ARC County payments this next year. The southern Indiana, they are going to get some help from the government programs, but that's going to be the exception rather than the rule.
And those are corn payments.
These are corn payments,
not soybeans.
So a couple of drivers there. One is the reason there's no soybean payments is because yields were so strong, right? And also the price situation.
Yeah, the price, it's the combination of those two makes the soybeans payments dry up. The difference between north and south, we've talked about this in previous webinars where we focused on the farm safety net, is the 2015 played havoc here. The yields were quite low in the northern half of the state. That had an impact on the revenue guarantees that we're still using for the northern part of the state. And so that's why the payments look so different between northern Indiana and southern Indiana. Conversely, in 2015, a lot of southwest Indiana had very good yields, and so their revenue guarantees are different than northern Indiana, and with the revenue guarantees that they're expecting to have, it looks like they're going to have some pretty good payments.
And the other thing to think about, which you've already made, but I think it's important to maybe reiterate, is the fact that as you look beyond the fall of 2017, the likelihood of receiving any payments on corn or soybeans here in the Corn Belt pretty much drops to zero.
Yeah, this isn't just Indiana. That's pretty much across the Corn Belt. We're not expecting payments in very many counties, and even if they are some payments, are going to be really small in 2017 and 2018.
Yeah, so and for clarity, when we say 17, you mean the 17 crop payable in 18, right?
18. Yeah.
So as you think about revenues here in the fall of 17, some locations are still going to get some substantial payments in the fall of 17 for corn based on the 16 crop. But as you get out beyond that, it drops essentially to zero.
Yes.
Okay. All right, good point. So let's kind of wrap this up, Chris, with some strategies. First of all, the tight margin period continues, right? We don't see that changing.
That's right. We're going to see continued adjustments where revenues are just simply low compared to the cost structure. What we all like for our producers is, well, just get the revenues, just get prices up. Our outlook is not saying that. A little improvement for corn, but offset by declines in terms of soybeans. So what that says is these tight margins, the kind of pressure we've been under for 2 or 3 years, we expect to continue, and that means continued adjustments.
And as we look at the budgets, we've been saying this for a while too, Michael, we think the strongest pressure is going to be on the lower productivity farmland, right? Whether you're in Indiana or elsewhere, we think throughout the Corn Belt, it's going to be the strongest on those lower productivity soils. The stress is going to be on both cash rents and on farmland values, right?
Definitely. They're just so far from break even on the lower productivity ground. We showed that earlier that one of the places we're going to have to see some reductions, I think, is cash rents, and that's going to translate into lower land prices too.
And some downward pressure on some other input prices as well, but the one that's probably going to see the most pressure is going to be the cash rents.
Yeah.
And your work going back for several years now has suggested that over the last 50 years, we do see adjustments in these cash rental rates. It just takes time.
It takes a lot of time, and we're still expecting, given the prices that we were talking about earlier, we've seen a 12% reduction on average productivity ground so far in Indiana. We're still expecting that to be 20 to 25% before the dust is settled, and so we're expecting a couple more years of some weakness in cash rents, and again, particularly on the average and low productivity land.
And Chris, you were talking earlier about the corn and soybean price ratio. We're getting back to that historical average, right?
That's right. And again, this is the way a business cycle, economics tends to work. You tend to shift in one direction and then market forces bring that back more to normal. But sometimes you see markets continue to shift for various reasons. So, yeah, we're back closer to equilibrium, giving incentives to plant corn and soybeans closer to equal incentives.
We've focused here on crop producers today, but I think it's worth noting here that the corn prices and soybean prices that we've talked about today are going to keep feed costs relatively low for the livestock industry, and it'd be very interesting to see what happens to soybean meal prices as we readjust the soybean prices.
Yeah, we're looking at soybean meal prices the lowest in probably 8 or 9 years. So we think we're probably going to be around $300 a ton, or maybe slightly more than $300 a ton for average Decatur high pro prices for this next crop year.
And we're in expansion mode across the
We're
board in the
expansion,
livestock
and
sector.
again, I think recovery and expansion, and this report certainly does not stop that. We continue to see the growth of our animal products continue.
So with that, we're going to wrap things up. I've got a couple of website addresses up on the slide for you. I want to point out that we do have a new Ag Economy Barometer coming out tomorrow, Tuesday, April 4th. You might want to tap into that. That's where we measure responses from 400 ag producers around the nation with respect to where they think the ag economy is today and where it's headed. So you might want to tap into that. If you want a little more detail on today's webinar, we do post a copy of the slides on our website. So if you go to purdue.edu/commercialag, you'll be able to download a copy of those slides. And also we have a link to a recorded version of the webinar, so you can watch the webinar or portions of it again at your leisure. Thanks again for joining us. We appreciate your support and look forward to visiting with you on another webinar in the near future.